Okay, today I'm with George Hall. George, you are a professor of economics. You worked at the Chicago Federal Reserve before. I would say it's fair to say that you have a black belt in everything financial history and how, government financing works. So first of all, welcome to Cassandra. Thank you for being here.
Oh, it's great to be here. Thanks so much for having me. Yeah.
Fantastic. So George, we just talk a little bit about it and that, there are loads of different ways how we can look at government financing and in particular measurements, right? And you told me that, from your research, you came up with, a framework that is really kind of looking at the difference between par value and market value. Can you just take us back, give us a little bit background where this is coming from? How did you get started on this path of of starting the research? So give us a little bit of background.
Sure. So the issue is that when the U.S. government, the Treasury, the Congressional Budget Office, the Office of Management and Budget, measures its debt and its interest payments, what it does is it uses an accounting framework. That is, it measures its debt at its par value, and it measures its interest payments by summing up the coupon payments on the long-term debt, so the official interest payments, and then it takes the capital gains on the zero coupon Treasury bills. Okay. Now what's nice about that framework is it doesn't require any judgment. It's very clear what the rules are, and it's very clear how they compute those costs. So no judgments involved. The problem is it's not what investors or the other side of that what its creditors care about, and it's not what would be sort of consistent with economic theory when we're thinking about what are the costs of borrowing. So as an investor, what you care about is not just the coupon payments that you receive, but also the capital gains and losses that you earn on the debt. That is, as the value of that debt goes up and down, you care about those capital gains, just as any investor would. So what we did was and then I should note that this is all joint work with Tom Sargent of New York University. What Tom and I did was to create a parallel set of accounts for the US government, in which we're measuring, the key differences are that we're measuring the US debt at its market value, and we're measuring its interest payments by the holding period returns on the debt. That is taking into account the changes in the bond prices. So as bond prices go up and down, that's giving capital gains and losses to its bondholders. And you might say, well, why does this matter? And you say, well, during times of sort of peace or relative calm in financial markets, it's not a big deal. Essentially, the Treasury, when it sets coupon rates on new issues, it sets coupon rates so that the market value about equals the par value. And in general, if interest rates are pretty stable, it's not the difference between the market value and the par value is going to be small. So you can say, well, why does this matter? But well, it's going to be at times of fiscal stress, during times of crisis, that the market value and the par values are going to differ. And bondholders are either going to get big gains or they're going to get big losses. And so when do you tend to see these things? Well, times like particularly war times, you see it like World War I, World War II, you see this in a big way. Or if interest rates are moving in, you've got large movements in interest rates. So like, for example, the early 1980s, when Volcker raised interest rates to bring down inflation. And what's important is that it by showing the market, by reporting the market values and the holding period returns on the debt, what it really does is it illustrates who really bears the costs of various government spending and expenditures. And some of these costs can be hidden if you're just looking at the par value and the accounting measure of interest payments. And I think where people have looked at particularly the US government spending and looked and said, boy, there appears to be free lunches here. there's kind of there's a crowd out there that basically says, a lot of government spending, there's free lunches. And you say, well, government spending might be a fine thing to do. I'm not opposed to government spending, but somebody's going to pay the cost. The bills always get paid. And you want to kind of identify who pays. And by looking at the market value of the debt and the holding period returns, it becomes clear who pays.
So who pays, the taxpayer or the bondholder?
So that's the big question. So there's basically three groups that can pay. If you've got, so it can be either the taxpayer that pays, the bondholders that pay, or it could be that future recipients of government spending incur the cost by cuts in spending. But somebody's got to pay the bill. And if you report the debt at its par value, then the bondholders can never really take the hit because you never record the losses to the bondholders. And sometimes that's true. And also, if interest rates say fall and bond prices go up, actually bondholders may be getting a gift from the government. The government can actually transfer wealth to its bondholders. So the transfers can kind of go both ways. And so so Tom and I got into this, setting up this set of separate second accounts actually in the 1990s. In particular, thinking about that was a period in which government was talking about paying down its debt and things like that. And to be honest, it didn't make a big difference during that period. It was more sort of a historical thinking about crises. I'd say, there wasn't a huge amount of interest in it. We got encouraged to look historically, to look back on history. And it's true that it makes a big difference when you look at like who paid for the cost of wars, whether you measure things by the market value or the par value. So we went back and did this historically, and we kind of developed a little bit of expertise in thinking about war finance and who actually pays. And we wrote papers and people said, oh, that's very nice. But then COVID hit, and the financing of COVID looks an awful lot like the financing of a war.
But that's very interesting, because from the research piece that I read from you, you were talking about, okay, we have a decreasing reliance on bonds and more reliance on taxes, right? But now,
yes.
In general, now COVID seems to have kind of really changed that, right?
Yes. So COVID, essentially, we did not raise taxes at all to pay for COVID. Okay, so we spent about $5 trillion. The United States spent across 2020 and 2021. We spent about $5 trillion to fight COVID, or in response to COVID. That's about a quarter of a year's worth of GDP. So that's a big number. Okay, 5 trillion. We did not raise taxes at all to pay for this. So we financed it all through borrowing of various types. Okay. And so basically the Treasury issued debt to finance, to pay for these expenditures. Much of the increase in debt was purchased by the Federal Reserve, and then you say, well, how'd the Fed pay for these bonds? What it did, the Fed expanded its borrowing from the banking system in bank reserves, and also it borrowed from the money markets through its use of reverse repurchase agreements. So basically what we did, if you want to kind of think about it, was we increased the spending. The U.S. government, Congress and the president increased spending, government spending. We financed it by issuing bonds. Those bonds were, in practice, there's a nuance here, but were essentially bought by the Federal Reserve, and the Federal Reserve paid for them by borrowing from the banking system and the money markets. And so, and then you say, well, how did the money? And so that's
borrow
basically
short,
how we borrowed it.
Borrow short
and lend long.
Yeah,
think about
exactly.
the Fed is this is an idea of Marvin Goodfriend's back with quantitative easing, it's the Federal Reserve, is an $8 trillion hedge fund. It borrows short, it borrows overnight, and then lends to the federal government with long-term debt. And so it does maturity transformation. And then, of course, what it did was it then raised interest rates on itself. And so it raised its borrowing costs. And so the Fed's now making large losses, as it's gone there. But that's another topic. But actually, like that's again like sort of measuring the debt at its market value. You get that you realize that the Fed, by raising interest rate, it raised its borrowing costs. It lowered the value of the bonds that it holds, and it's imposed $1 trillion of capital losses on itself, and it's now losing $2 billion a week in interest payments.
To which extent is this actually like a global phenomena? Is that like obviously there are always nuances, but you have a pretty global view on things. So
yeah, so most of our research focuses on the U.S.
Sure,
but I will say that what governments all around the world, when COVID hit, basically we had to shut economies down. So it was a lousy time to raise taxes. That's the exact wrong time to raise taxes. You wanted to actually increase. Much of the spending was transfers to people who, we tell them not to work, and then you've got to subsidize. If you're shutting down the economy, you've got to keep people from going bankrupt. So you've got to write them checks, and you can't pay for that. You can't raise taxes. So almost every government issued debt to pay for COVID. Some spent more than others. And now we're in a period in which it's kind of, okay, well, how the bill comes due, you say, how is this going to be paid for? And the question is, are you going to pay for it by raising taxes? Are you going to pay for it by cutting spending? Or are you going to pay for it by delivering low returns to the bondholders? And what we see is that essentially it looks like in the US and around the globe, COVID's going to be paid for by low returns to the bondholders. And those low returns can come kind of through two different channels. One is through inflation, just a rise in the price level, that prices are going to go up. If you look at, and then two is that interest rates will remain, just generally higher. And with interest rates being higher, the people who bought these bonds, back in 2018, 2019, 2020, 2021, when they bought them at very low coupon rates, are going to realize that their bonds are no longer worth par. They're now worth 85 cents on the dollar, 90 cents on the dollar, because interest rates have gone up, bond prices go down. So we're going to impose losses on these bondholders kind of two different ways. One is through higher interest rates, and then second through inflation. There's a lot of talk today about how inflation is transitory, but it's not like the price level is going down.
Yeah, I think, can you just unpack this or maybe elaborate a little bit more on the inflation side? Because it's we are recording this mid-July 2023, yep. And latest data is 3% inflation in the US, 4.8 core inflation. So that obviously includes energy and, food, etc. So how do we explain this? So it seems to me that, the narrative has shifted. There's still a hike priced in and so on and so forth, but there's a shift again in narrative. But you are saying, okay, there's something more structural that we need to kind of pay attention here, right?
Yeah. So I would keep in mind, these are all inflation rates are increases in the price level. And just think about a little bit of this is where thinking about going back to wars matter. So after World War I and World War II, within a few years of the end of both of those wars, so think about sort of basically 5 years after the war ended, the price level was 50% higher than it was when the war began. Okay. It's just the consumer price index. That essentially means that the bonds that were issued to pay the bond are now worth 50% less. That's just imposing a loss on, that's a loss, okay? Now, to make the bondholders whole, you'd have to do something like what we did during the gold standard, where if you raise the price level during the war, you bring it back down. And you not only have, inflation rates aren't just low, they're negative. To return the price level to what it was, to return the value of those promises on the dollar. There's no talk about running negative inflation. And so prices are going to be higher. And it's true, right now, the rate of increases has slowed. But what we would emphasize is that this is not, it's still 3%. And if you bought a bond in 2020 with a 2% coupon, you're still losing.
Sure.
I mean, you're getting negative returns. And then secondly, that these things can take a while. It's going to take a while for this thing to filter through the system. And if you look at World War I and World War II, yeah, the price level didn't jump immediately, but over the course of sort of the 5 years after, you saw prices just continue to go up. And we see, I can't help but think that there's a lot of pressure still for prices to rise. We're running large deficits. Unlike World War I and World War II, where we ran surpluses, that is, we set taxes above spending immediately after those wars. Here in the United States and in many other countries, we're going to continue to run primary deficits, adding a lot of fiscal stimulus that, you can say, well, the monetary authority should then, raise interest rates to lower aggregate demand. But remember, they've got to counteract all this deficit spending that's increasing aggregate demand. So you've got that on there that's going to add inflationary pressure. And I mean, if you just kind of look at like who's going to pay for this $5 trillion, it's not going to be the taxpayer because there's no interest in the United States in raising taxes. It's not going to be recipients of government spending because there's no interest in cutting spending. And so the only group left is the bondholders. And I think they're going to be the ones that pay the losses, that incur the losses. And so then you think about, well, who are they? A third of them live abroad from the United States. And that's, imposing losses on foreigners to subsidize our spending.
Sounds good.
I mean, the U.S. taxpayer is going to go, yeah, we do that, yeah.
But like, when you say like, okay, like things haven't like properly played out yet, but you already kind of, mention a couple of factors. Like, how do you see the next, let's say the medium term, let's say 3-5 years, how it's going to play out?
I mean, I think there's going to be continuing inflation pressure. So I think, inflation came in at 3% last month. It is not the time to go fly to an aircraft carrier and make a speech with mission accomplished behind your, banner behind you. That's the Fed's not out of the woods yet, and the Fed is really going to have to fight a lot of pent-up. I mean, because not only do we have this $5 trillion out there, and they've got now an $8 trillion balance sheet that they've got to unwind. We've got a lot of fiscal stimulus that's sort of built in. We've got deficits for the next 10 years, and large deficits, not that large. So that's going to provide a lot of fiscal stimulus to the economy. And you just sort of, I think there's going to be continued inflation pressure, which means higher interest rates. I think the days of zero interest rates are over for the next 3 to 5 years. I think it could easily be that we see, where the last decade, decade prior to COVID, we had inflation well under 2% most of the time. I think seeing inflation rates that are 3, 4, 5 for a bunch of years could be normal, and real interest rates being higher, so just nominal interest rates being significantly higher than what we saw in the previous decade before COVID.
Interesting. So no going back to normal. like
Well,
after
it's a new normal.
28,
It's a new normal.
2008.
Yeah,
Yeah, exactly.
yeah, it's a
Exactly.
different normal. I mean, in some sense, that decade was an abnormality. I mean, zero interest rates, borrowing costs is close to zero. It's crazy. Um, yeah.
Any like before we wrap this up, like
Sure.
any kind of other lesson of history? I mean, you looked at like so many periods, like not only wars, like different financial crises. COVID was in a way like a war, right? From
Yeah. I
a
mean, it's
finance
sort of,
perspective. But
Mhm.
any kind of lessons that we can kind of draw and maybe apply to today, or anything like that stood out to you that you think like, oh, this is interesting, maybe this would solve problem X, because obviously we are heading in the US, we're heading into an election. So
Mhm.
or is politics actually like maybe like there is not even like any kind of change, it's just like a structural thing, and it doesn't matter
Mhm.
who's in charge, or any other kind of lesson that we can kind of like learn from history.
Sure. I guess well, let me talk a little bit about um dollar dominance. So prior to World War One, we lived in a pound dominant world. So the British pound was the global currency. And World War One bankrupt England, and the US came out much stronger. And the center of the financial universe, I mean, England was a creditor country um, prior to World War One, and ended up being a debtor nation after World War One. And the center of the financial universe moved from London to New York, and contracts started to be written in dollars, and the U.S. dollar became the global currency and sort of cemented that position immediately after World War II at Bretton Woods. And so I don't think it's an accident that when you think about World War One and World War II, it created a big structural shift in uh, in finance, particularly moving away from the pound and toward the dollar. And so now, a huge number of contracts are, globally are written in dollars. A lot of international trade is written in dollars, and the dollar is seen as the leading reserve asset. And the question is, could COVID be sort of the moment that where you start to lose dollar dominance and we create some alternative? Is it a paradigm shift in finance that would move the globe away from the dollar? And I guess let me say that I think I'm skeptical uh, for that, because I don't see who would be the alternative
Right.
asset. I think Europe with the euro would like to be that alternative, and I think the euro will always be a major currency and always be a bit of a challenger to the U.S. dollar, but they're in the same boat that the U.S. is in many ways. The same issues that are facing the U.S. also face Europe, and given their sort of fiscal and monetary structures, in many ways, their situation's even more complex than the U.S. And then I look at places like China and India and Brazil and say, could they provide a competitive alternative to the U.S. dollar? And I come to the answer that no, given that if you want to be a global currency, what you need is for people to hold your currency for no other reason but to carry out transactions, which means in order to get the currency, they need to sell. Like if a foreigner wants dollars, the way you get dollars is you sell US goods and take those dollars and then never spend them in the United States, but use them to carry out transactions outside the US. But that means that the US has to run a trade deficit. And that's I think, the main source of our large trade deficits in these last 20 years
But,
or the
but
last 50 years really, is a consequence of the dollar dominance. Um, and are China and India and Brazil willing to run trade deficits? And I think the answer is no.
don't you think it has also like it is really has something to do with the store of value?
Yes.
And it's really like very little to do with, this payment scheme. Yeah, we can have all sorts of payment schemes, like there might be swap lines to country X from China, then I buy a lot of goods and in these kind of things from China. But it doesn't seem to me that the store of value story is going anywhere.
Well, yeah. I mean, well, the question is, will the U.S. be a good store of value if we're running 3% and 4% and 5% inflation? We're not a very good store. It's not a very good store of value. You're losing value, and that's a transfer from foreigners to the United States. The question is, what are these swap lines denominated in? You gotta denominate them in some currency. And generally those things are denominated in dollars. I mean, most contracts are written in dollars. And could you, I mean, it's sort of a line that, yeah, the US dollar may not be great, but it's the phrase is, it's the cleanest dirty shirt out there.
Relatively speaking, exactly. Okay.
Yeah, what else? There needs to be something else. I mean, and the question would be, would a government be willing to make the hard choices? And would it be worth it to make the hard choices? I mean, there are consequences. I think the trade deficit is a consequence of our decision to be a dominant currency. And it has consequences. It creates winners in the United States, but it also creates losers in the US. And so does someone else want to take on those costs and benefits? That's up to. I think it's easy to talk and say, "Oh yeah, we want to do that," blah blah blah. But it's.
I mean, it's definitely good for views and like these kind of pub discussions because there's always like some de-dollarization kind of like news coming out pretty much every year since even I remember, and like apparently this is going on already since the 70s. So who knows? But it's a relative game. So yeah, George, like before we stop, like where can people find you apart from Cassandra?
So the easiest way is just Google George Hall economics, and I'll pop right up on my webpage. I have a webpage at Brandeis and on ScholarWorks as well. Yeah.
Perfect. George, thank you so much for coming on. Cheers.
Thanks so much for having me. It's been fun.